In this video, we're going to talk about Tesla, trading under the ticker symbol TSLA. We're going to cover the price action over the past few days, the company itself, and the recommendations regarding buying, holding, or selling the shares. If you would like to see more stock analysis videos, please like, comment, and subscribe to my channel. But before today's video begins, I'd just like to clarify a few things about the timing when my videos are recorded, uploaded, and how much they react to the latest market updates. So most of my videos are recorded and scheduled the day before and uploaded for the next day. For 5 days out of 7, it's a trading day, so of course by the time the video goes live on my channel, the price would have already evolved from there. If there are significant and very volatile movements during the trading day, obviously they will not appear in the video on that day. But usually, to the extent possible, my analysis will be based on the medium term and not really focused on the intraday movements. The reason why it shouldn't matter that much either way is because most people investing in stocks invest for some kind of reason that takes time to get developed, and that their positions are usually kept for at least a few weeks. With that being said, if there are significant stock price movements that happen afterwards, either they will not affect the overall picture, or if they're significant enough, they will be mentioned in the next video about the stock with reevaluations of the circumstances as needed. Tesla is an electric vehicle company manufacturing fully electric vehicles and also provides services related to the energy storage and other renewable energy resources. It is a relatively diversified company with products servicing different sectors, segments, or customers with different needs. Tesla is often viewed as the flagship of an entire sector because its stock fluctuations may influence the rest of the sector, or even the tech stocks in general. Many portfolios that are future-oriented tend to be relatively heavy on Tesla's stock price because it is the undisputed leader in terms of sales, technical expertise, and established influence in the sector. Another appeal of Tesla is its CEO, Elon Musk, who is one of the most recognized names and figures in the industry with a global following. The market cap of Tesla is currently at $1.02 trillion, with the enterprise value at $866 billion. The market cap is the price tag financial market wants to evaluate Tesla at, considering its future potentials and current fundamentals. The enterprise value of the company is the net result of the company's assets once all the debts are paid back. Usually the market cap is higher than the EV, but sometimes there may be exceptions because the company may be highly leveraged or the company may be under a lot of pressures from the market, such as large short positions. The quick ratio of Tesla is 1.1. The current ratio is 1.39 and the debt over equity is 0.36. The average trading volume of Tesla has been 22.42 million shares, and the daily volumes has been 19.2 million shares, 19.8 million shares, and 13.3 million shares. The 1-year beta of Tesla is 2.57. Its 52-week high is $1,243.49, and the 52-week low is $539.49. Now, let's also talk about options market for Tesla. In terms of volume and open interest, the options market seems to favor the call side. Generally speaking, the put options mean that the market expects a pullback. The calls options mean that the market expects the prices to move up. The key strike prices where there seems to be the most interest are $1,000, $1,020, and $1,050. Tesla has definitely had a wonderful year from a yearly perspective since it went above $1,000 before many people have predicted. With that being said, there are quite a few people who bought it when it surged above $1,200 a few months ago, and ever since then, the share price has been on a downward trend. Each peak is lower than the previous one, and each low has been lower than the previous low as well. So clearly, people have been on the selling mindset over the past few weeks, and that includes its CEO, Elon Musk. So regarding this, you may say that Elon is selling more shares because he promised to do so, but I'm not questioning the action per se. But it's just an additional fact that this is a new contributing factor that is stacking against those who would like to see the stock price moving higher. This is why I think that for the short term, Tesla will need to spend some time to adjust to people's expectations and their needs, which may be contradictory at moments. On one hand, people may wish the stock to move higher, especially for those who bought it. But if we are honest with ourselves, I'm pretty sure that it'll take some time before continuing to climbing up. And that is actually quite healthy for the stock in the long term. My recommendation is to keep Tesla as part of your portfolio and definitely as a stock to buy over time. But it's better to wait for when the price corrections are over to continue buying. Many would wonder how to tell when a bottom is reached. Well, we usually know it when it's already behind us, and that's okay. For a stock like Tesla, I would say that it can take up from 10 to 20% of your portfolio. Your investment should also take into consideration the market conditions at the time and the surrounding sentiment to determine what kind of asset should be picked, for how much and for how long, and when you should be selling it. First of all, the financial market doesn't reflect the real economy. That much is a fact. If the stock market is doing great, it doesn't mean that the underlying company is necessarily hiring more people, increasing the wages, and rising the living standards of its employees. Sometimes it's even the exact opposite, because the stock market is a big pool where money comes in and out, goes to different places in order to be placed. The capital may be used to be invested in a company to improve its efficiency and productivity, but it can also be used to buy up shares and assets in order to make a profit. This phenomenon is called financialization, and it means that the more money is been used for non-productive purposes like mergers and acquisitions, paying dividends to shareholders, buying back equity, and so on, the less there is for the productive parts. Another way to put it is that ever since 2008, the Dow Jones Index has increased its value significantly. But people don't necessarily see this growth in the main streets. This is why we should be careful with the assumptions of what rising prices mean for a company. Sometimes it doesn't mean anything, other than the fact that the asset is getting more expensive and that their yields is going down. Additionally, some new phenomena are now palpable, and they are the creation of new bubbles, the participation and influence of retail traders in specific situations, and the anticipation of a massive recession or at least pullbacks. Bubbles have always been created over and over during the past few centuries, ever since there are financial markets. But nowadays, it's quite interesting to see that the speed at which they are created, attract people or capital, and then go bust is getting faster and faster. So almost immediately after the major collapse of the market prices back in early 2020, the same market decided to create a massive bubble of the electric vehicle sector or anything that is related to it. So almost immediately after the major collapse of the financial market back in 2020, the market then decided to, one, recover any sort of price that fell during the first 3 months of the year, and then attract a massive amount of capital into the EV sector or anything that's related to it. Stock prices across the board, but in the growth stocks in particular, went up to the sky for a moment. And even if it didn't last long, this episode definitely allowed market participants, or many of them, to park in their money in a sector and left with either a lot of profits or at least avoiding incurring large losses because they left their money in blue chips or the sectors that are heavily affected. The involvement of retail traders in companies has also been much more pronounced in recent months, because in the scenarios of a short squeeze, companies may have short sellers who believe that the stock will decrease in value. The short squeeze consists of buying the stock price up to force the short sellers to recover their positions, which will then trigger even bigger increase in stock price. But I'm not saying that this is always rational, and I'm not even saying that companies will always have a very convincing narrative or good fundamentals. Sometimes there's none of that. A good example is with GameStop. If you play video games, ask yourself if you would really always buy your games at GameStop, knowing that you would be buying those games online as well, or knowing that at least you have the capacity, the right to buy those games online in the comfort of your home. But nevertheless, retail traders do have a much more significant influence in the stock price, for the better or worse. Personally, I think that as long as the volatility is high, it'll create opportunities. The final phenomenon is the anticipation of a recession. Many people are expecting something of that sort to happen ever since 2008. There were quite a few companies that were supposed to go bankrupt because of the debt structure no longer sustainable, or that their business model is just bad. But somehow that system was able to hold its ground, especially in the North American market. This is partially because the capital around the world chooses to come to American capital market when things get heated back home. This is especially the case when geopolitical tensions increase around the world. In order to make sure that the capital can provide steady returns without being affected too much by central bank policies and inflations, this phenomenon will intensify over time. The bottom line in all this is that the environment is getting more uncertain and volatile in a context where asset yields will probably remain low, because the real economy cannot just improve because the asset prices go up. As far as we're concerned, that means that the patience of market participants over the next couple of years will be a great virtue, and that there will be plenty of opportunities to eye for better prices. With that being said, always make sure to keep your positions diversified and your risk level under check. Your speculative positions should play a relatively modest part of your overall portfolio, so thanks for watching. If you like my content, please like, comment, and subscribe to my channel.